This is Macro Horizons, episode 375, Simmering Summer, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 26th. As temperatures rise, we expect the same will hold true for gasoline prices, headline inflation, geopolitical tensions, and our broader market angst. So much for road trip season. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there wasn't a great deal in terms of economic data to drive the broader trading direction in U.S. rates. Instead, what we saw was a steady grind higher in Treasury yields that, frankly, triggered more questions than it answered. The magnitude of the move was arguably disproportionate to the shift in the fundamentals. To be fair, the Strait of Hormuz remains closed and energy prices are clearly biased higher. And we also saw a solid print from the ADP weekly jobless series, as well as a decline in jobless claims. However, from a flows perspective, there was plenty of chatter about positions being stopped out and convexity selling, both of which resonate given the fact that we were near the upper bound of the range before the developments of the week. We did see a bit of supply in the form of the 20-year auction, $16 billion, that stopped through a very slight 0.1 basis point. Overall, however, it was a market that proved content to trend toward higher rates, even though there was plenty of uncertainty to go around. In this context, we find the front end of the market to be particularly interesting at this moment, given that about 2 weeks ago we were pricing flat or some probability of a rate cut between now and the end of the year. That has shifted, and we're now pricing in almost a full rate hike by the end of the year. Now, this is not our base case scenario, nor do we think that at the end of the day it ultimately comes to fruition. But with the odds of a rate hike increasing, we have seen the 2-year sector ratchet to a higher rate environment, with four-handle twos becoming the new norm. Ultimately, we do think that 2-year yields above 4% will eventually prove to be a buying opportunity. However, given the magnitude and the severity of the recent repricing, we're reluctant to step in front of the move, especially when combined with the FOMC minutes that were released in the week just past, where we learned that the hawkish tone of the three dissenters was shared by others on the committee, even though they opted not to vote against the slightly dovish forward guidance within the FOMC statement. At the end of the day, we do believe that when the Fed is eventually back in motion in either direction, either cutting or hiking, that it will be a function of the realized economic data and the forward outlook once we have some greater clarity regarding the potential fallout from the war in Iran and the ability of the U.S. consumer to continue moving economic growth forward in real terms.
Without any truly top-tier economic data this week, and, let's be honest, Memorial Day weekend and the unofficial start of summer occupying a lot of investors' attention, it was a week in financial markets that was dominated, obviously, by headlines coming out of the Middle East, but also the price action itself in treasuries. Following Friday's bearish breakout, we saw a meaningful follow-through toward higher yields across the curve, with 10s now definitively above 450, and no shortage of conversations around the likelihood that we were ultimately going to reach 475 in this latest backup. Now, for a discrete catalyst that kicked off the move, it was difficult to pinpoint any one thing, but rather we'll characterize the move as partially technically driven in nature, partially Iran-driven in nature, with a little bit of help from some hawkish FOMC minutes, and the fact that, for the time being, given the broader level of uncertainty, there's simply not that much appetite to catch the falling knife, at least not yet.
And it was also an interesting move insofar as it kicked off the prior Friday with a sell-off in the gilt market, that then led to a bit of contagion with U.S. rates pushing higher. That set the tone as we came in on Monday, and as you point out, Ben, it was largely about developments in the Middle East and the potential for a durable peace deal. The FOMC minutes were interesting. They were hawkish minutes from a hawkish meeting, however, so there wasn't any great insight contained within the official Fed communication. It is worth noting that the committee observed that in the event that inflation ends up being more persistent over the course of the year, that the Fed will not only delay rate cuts, but also consider higher policy rates. This is certainly not our base case scenario. However, in being intellectually honest, there is a path forward to rate hikes, and it's simply a persistently strong U.S. economy that sees inflation flow through from the headline to the core measures throughout the course of the year, and the continued strong performance in risk assets, most notably the equity market, with an unemployment rate that's comfortably below 5%. We suspect that, as is often the case, one of those is not going to hold true between now and the end of the year, and as a result, we anticipate that there will be cross-currents for the Fed's dual mandate. Interestingly, that also doesn't preclude the potential to restart rate cuts by the end of the year, but the bar for doing so remains high and would need to be a function of a spike in the unemployment rate, negative payrolls growth, and benign nominal wages. But at present, all signs suggest that that won't be in the offing anytime soon.
And as we think about the likelihood that the Fed ultimately will need to raise rates, with now almost 100% probability of a hike priced into the very front end by the end of the year, it's important to consider that in this period of bearishness in the longer end of the curve since the war began, the sell-off has taken on a slightly different character over the past few weeks. Specifically, early on, it was a primarily inflation expectations-driven story, with break-evens widening materially as the market repriced to the reality of higher oil prices for a more prolonged period of time. However, more recently, in the wake of the FOMC, in the wake of payrolls, and as we've continued to get resilient economic data, the sell-off has transitioned to more of a real yield story, with break-evens still high, of course, but the fact that real rates have begun climbing and equities have, at a minimum, stopped setting all-time highs during consecutive sessions shows at least some financial conditions tightening impact from the combination of the increase in real rates, some widening in spreads, and at least modest pressure in equities. Now, it's certainly not the variety of tightening that the Fed would respond dovishly to, and frankly, even if Warsh might not admit it, it's probably a welcome tightening at this stage given the upside inflationary risks facing the economy. The latest moves in the market and higher rates are going to have a negative growth and inflation impact that will ultimately help mitigate the risk of runaway inflation. So, said differently, it's the market doing some tightening for the Fed. And to your point, Ian, the fact that we're not likely to see any near-term catalyst for rate cuts, and the market is taking some of the edge off the need to hike anytime soon, that really just points to a obviously data-dependent, but nonetheless steady monetary policy outlook for the foreseeable future.
And when we take this into context of Kevin Warsh's first meeting as Fed chair, he certainly will have his work cut out for him if he has any intention of trying to deliver on lower rates over the course of the next several meetings. That being said, it's doubtful that Warsh is trying to build consensus for a rate cut at this point, simply because there are so many uncertainties associated with the war in the Middle East, and the economic data continues to demonstrate a remarkable amount of resilience for not only the labor market, but also growth more broadly. Now, admittedly, part of the growth outlook is contingent on a continued AI build-out, but as recent quarters have demonstrated, that has had a meaningful impact on the overall growth profile. When we think about what in the real economy could derail our assumption that the Fed will remain on hold for the foreseeable future, one has to consider the state of the consumer, particularly personal spending in real terms. What has become evident via the March and April data series is that headline inflation has been very pronounced, while nominal wage gains have continued to moderate. So that means in real terms, personal spending capacity has deteriorated, and that is admittedly troubling for the outlook for the next several months. Now, in the event that the May BLS data reveals an uptick in average hourly earnings, and the May CPI data revealed a downtick in inflation, then the consumer will have reasonably successfully navigated the initial response to the supply shock in energy. We're more concerned that over the course of these summer months that we will see oil inventory drawdowns lead to greater physical demand, which will in turn drive up futures prices. And it's when those futures prices start to set new highs that we will look to risk assets, again, the equity market in particular, to demonstrate some degree of vulnerability to an extended period with elevated energy costs.
And especially as we head into what will be a summer of uncertainty, really what has become the main question is not whether we'll see a growth hit from, obviously, a very strong departure point in terms of domestic consumption, but rather when that takes place, and the fact that every energy spike looking back over the course of the last several decades has served as a precursor to a recession bodes poorly for the labor market and the broader consumption outlook toward the end of 2026 and 2027. And it's this underlying angst that should keep a lid on treasury yields. We're not expecting 10s to go to 5.5% or 6% anytime soon. And the fact that real yields have now climbed so much bodes well for investors who are of the opinion that ultimately the strength of the economy and the current pace of job growth and consumption is not going to be able to withstand the current macro backdrop. After all, from an economic perspective, it hasn't been that long since oil repriced to the realities of what's going on in the Persian Gulf, and it will take time for the accumulation of the damage done to household balance sheets from higher prices at the pump to flow through to behavior, and ultimately longer to flow through to the data. This all with the backdrop of the potential for higher labor productivity and concerns about the job market surrounding AI, which, while is a longer-running narrative and one that's on Warsh's mind, will keep enough economic concern in place that this sell-off will ultimately probably be a good buying opportunity, but that doesn't mean we've already seen the high tick in yields during this latest bond market rout in the US, in Japan, the UK, and frankly, every fixed income market.
You make a good point. This is not necessarily entirely a U.S. Treasury story. This is higher rates globally, because of fiscal concerns, because of inflation concerns, because of borrowing needs. And frankly, this is not a particularly new narrative for global fixed income. In fact, we spent much of last year talking about the potential for increased auction sizes, for more sovereign borrowing in developed markets. However, at the end of the day, the fundamentals overshadowed any such concerns as 2025 came to an end. We'll argue that the push higher in nominal rates globally is something of a luxury afforded to market participants by the fact that the real economy remains on strong footing. Had we seen a negative GDP print for the first quarter in the U.S., conversations would be much different regarding the potential for higher borrowing needs in 2027 and beyond. But for now, the market can contemplate higher term premium and ponder the question whether or not the U.S. economy can withstand a 30-year yield sustainably above 5%.
At this point, you might as well dust off the playbook for those 50-year bonds.
In 50 years, this would be episode 2975 of Macro Horizons.
And nobody needs that.
Certainly not us. In the holiday-shortened week ahead, there are a few key data points of relevance. The highlight will be core PCE, which is released on Thursday morning and covers the month of April. Here, the consensus is for a 0.3% gain in the Fed's preferred inflation gauge. And while that might be lower than what we saw early this year, it's still above what the Fed would need to see to achieve its inflation objective. Within the same report, we'll be focused on the real personal spending figures, which have remained in positive territory, but given the moderation in nominal wage gains seen in April and the sharp increase in gasoline prices and headline inflation, we suspect that if anything, there should be some downward pressure on spending in real terms. Now, the market is clearly not trading the growth risks associated with higher energy and food prices, and instead has remained focused on the inflation aspect of it. We'll make the argument that the U.S. economy is not in the same situation that it was in 2022 and 2023, where consumers were seeing significant nominal wage gains and that afforded them the opportunity to chase inflation higher. Instead, with the backdrop of benign wage gains and any fiscal impulse from tax refund season likely having run its course, we have grown increasingly worried about the state of the consumer as driving season picks up and we move into the summer months. We'll also get some of the high-frequency numbers on the labor market, including jobless claims, as well as the ADP weekly figures, which both have been demonstrating resilience in the employment market, which, as we've argued, has cleared the path for the market to trade developments in the Middle East solely from the perspective of a risk to higher inflation. On the supply front, the week ahead also contains the final nominal coupon auctions of May, and that includes Tuesday's $69 billion 2-year note, Wednesday's $70 billion 5-year note, as well as Thursday's $44 billion 7-year auction. As a theme, we generally expect that the supply will be reasonably well received, although the performance of 3s, 10s, and 30s suggests that a greater auction concession will be needed either in the run-up to supply or via a modest tail at the auction itself. Nonetheless, there remains core demand for treasuries as an asset class, and we're not particularly concerned about any pullback in overseas sponsorship at the moment. At the end of the day, nominal rates continue to be largely a function of forward growth and inflation expectations further out the curve, with, of course, a healthy dose of term premium, and in the 2-year sector, simply a function of monetary policy expectations. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we prepare for the long weekend, we fondly remember the days of working from home when, let's face it, every weekend was 4 days long. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.